Rapidly evolving landscape of real estate crowdfunding platforms has opened up new doors for developers and investors. Whether it's the ability to raise money to fix or flip a home, raise money for large-scale developments, and even buy distressed mortgages. With more of that, I'd like to introduce my panel. We welcome first Daniel Drew, CEO of First Realfund, a commercial real estate crowdfunding platform. Steen, CEO of CrowdStreet, the provider of online commercial real estate investment marketplace, and Jamie Ostrow, Chief Executive Officer of CrowdCheck, a company that collects and provides information to potential investors who may use that to avoid fraudsters and make investment decisions. So why don't we go around first and just get an intro on your fund or your firm and what role it plays in the crowdfunding space for those of you who have a fund.
Sure.
What do you invest in? What are the advantages? Talk about
Sure. So First Realfund is a real estate crowdfunding platform. One of the key differences between us and a lot of our competitors, a portion of our mission is to make a co-investment in every offering that we make. So that includes a level that could be as little as $20,000, could be as much as $100,000. But every offering that we have on our platform, we make a co-investment.
CrowdStreet is an online marketplace for accredited investors to invest directly into commercial real estate across the U.S., all different asset types of commercial real estate. We've been around since 2013. We've had over $400 million of equity placed into those projects, and the average investment size has been $50,000 per investor, with an average portfolio of $250,000 per investor.
CrowdCheck, where I'm the Chief Administrative Officer, is a due diligence and compliance office. So we basically assist companies, issuers that are like working on either of these platforms or using some of the other Job Act exemptions, including Reg A and Regulation Crowdfunding, in order to raise funds.
Mm-hmm. So talk to me a little bit about what kind of assets, for those of you who are investing in assets, what kind of assets are you looking for? What's the minimum investment for somebody approaching your fund? How does somebody look at, what are you offering an investor who might consider your fund?
That's a lot to answer, but I'll do my very best. You know, the first thing that comes to mind, Tor mentioned the average investment on his platform is about $50,000. The average investment on ours is right around 25 or 30. And one thing that I'll mention as we get going here is that we're talking about commercial real estate investments. I know that during the conference here today, we've talked about a lot of equity investments in companies, which are very risky. In some instances, can be much smaller raises. $1 million, which would be our typical or even minimum raise size, is a relatively small amount in a commercial real estate deal. So the benefit for us is that this is a highly scalable business. I think we all agree with that. Yep. And so what kind of assets do we offer? Multifamily is the go-to bread and butter. It's the easiest asset class to understand. It's relatively less impacted by some of the potential financial implications given where we are in the investment cycle. We like industrial assets. We like hotel assets. We like retail assets. Even with the Amazon presence, we still think that certain retail assets are interesting, and inevitably mixed-use assets that have an interesting story. Any component of value add is something that we really like to have on our platform. There's 10 different things that I could talk about, but I think those are sort of the key things right off the bat.
Yeah, since the beginning when we started CrowdStreet, our vision was to transform investing in real estate by making it accessible, transparent, and efficient. Three things that it traditionally has not been. You had to know a developer operator in your local region, right? You had to be invited to invest, and many times you had to invest at $250,000 or greater. So that was kind of part of our vision when we started the company several years ago. I'm excited. We now have several thousand investors on our marketplace. Again, investing at increments of $25,000, $50,000, $100,000, building a portfolio, a diversified real estate portfolio. Last year, we surveyed our investor community and we asked them, what were the top 3 reasons of why they liked the CrowdStreet marketplace. Diversity was by far the largest reason that they enjoyed it. Quality of product was second. And so diversity of asset type is really important. So we offer everything from multifamily to senior housing to industrial to office to storage. And it's not just the asset type, right? So you want to have diversity of asset type. You also want diversity of geography. CrowdStreet's marketplace, we've had offerings in 40 different states, primarily in secondary markets where the average project value is in that 30 to 40 million range, where the equity requirement is kind of 5 to 10 million. So they're not going to get an institutional check, but they're used to raising capital from high net worth investors. So those sponsors, those developers and operators are used to that in an offline world. We're simply bringing them online to expand their base of investors and give investors choice and access and diversity.
do you want to add anything? I know you're...
So I was going to say, I don't have much to add on the asset classes. I could talk a little bit about what our clients do, which is, a little bit all over the market. We're seeing in e-commerce industrial space a little bit. We're seeing multifamily space. And just, we're seeing a lot of our clients use, rather than Reg D, Reg A, which allows for going out to the crowd and not just accredited investors in order to invest.
So in addition to a diversity of asset class, in addition to diversity of geography, we also have the ability to have diversity of offering type or investment type. So we can do joint venture equity, we can do preferred equity, we can do senior debt, we can do B notes on a senior debt. Each of these offerings can have a really specific flavor. And so when you have a massive crowd, which fortunately we do right now, and we can talk more about the crowd later, we happen to have a flavor for most investors that have some sort of interest. Now, the one thing that we haven't discussed that we probably should is the corresponding yield for each of these. Each asset class, geography, and frankly, each sponsor has a different yield requirement. And so one of the things that I will mention, and I think we'll talk about regulation more later, is that a component of the evaluation that we put into each of these offerings is who is the sponsor? What's their experience? Do they have competitive advantages? And part of that evaluation of that sponsorship includes CrowdCheck, which is a service that you guys provide, which is, have these guys, do they have any history of, what's it called?
Bad actor.
A bad actor report. So anybody that has greater than 20% ownership in a sponsor that we're raising money for, frankly, anybody that's even featured on a website, whether they have ownership interest or not, is subject to a bad actor check. And so there's a large amount of diversity, and there's a large amount of research that goes into each of these offerings.
Actually, since you brought up the concept of bad actor, let me open it up and maybe start with Jamie. I mean, how are investors protected? I mean, this is a new concept. You're talking about some investors are accredited, some are not, depending on the regulation. How can they vet a fund? What should they consider when they're about to invest a fund to protect themselves?
And I will say that my company does more of the due diligence from a corporate aspect. We will not get into the business aspect of it. We're lawyers. What you look for is you want to go through, like if you're a accredited investor, like one of these companies, you want to look through the documents. What do they say? Who has rights on certain things? Like you're going to be a minority holder potentially. What does it mean? What can the majority do without your approval? And just look at, and again, they vet them. What is the sponsor's record? A lot of them have long records of this is what they've done in the past. How have previous funds done in the past? Obviously, a previous fund doesn't necessarily won't necessarily show how they're going to do in the future, but that's helpful to know. And just get a sense of who is running the company, because all these funds are new, and or a lot of them are new. You want to know who the people are.
Tor, who are you? Who's running your company?
Yeah, and I think there's really, when you look at it, three legs of the stool, right? There is commercial real estate expertise. So when you look at the company and you look at the leadership of the company, do they have an individual or individuals that have depth in the commercial real estate industry? Do they have people on that team that have depth in kind of the private equity side and capital market side of commercial real estate? And then do they have leaders in a team in the internet and technology side? And I kind of think of those as the three legs to the stool. Sometimes they've been top heavy in one way or another. When we built CrowdStreet, we kind of kept that in mind. My co-founder comes out of deep commercial real estate expertise. Our VP of investments has been doing private equity real estate for the last 20 years of his career. They've built teams around them with those chops. I happen to be an individual that has brought the internet and technology into industry, so I have a great head of engineering and head of product with deep expertise in building scalable solutions.
Thank you.
Yep.
And how do you, are there any advice that you have to investors about how to vet you or how to vet other firms?
Sure. One of the panelists earlier today, I think, asked his panel, they were primarily focused on equity crowdfunding, and he asked, I've got 2 kids and a mortgage, and I'm looking at years of tuition. Are these really prudent investments for me? And one of the challenges that we have is that each of these private placements is fully regulated. We go through a broker-dealer called North Capital of Salt Lake City. So part of our daily operations is getting to know investors. And while we love to integrate and we can solve a lot of problems with technology, people can sign documents online, people can send money via ACH, they still want to know, have we had a conversation with these people and are these appropriate investments? And there's a series of disclosures in every offering that we make, but as excited as we are about the potential tokenization in this industry, as excited as we are about AI in this industry, SEC and FINRA still wants to know, have we had a phone conversation? Is this appropriate investment or not? So I think that the answer to the panel before was some of these investments are absolutely applicable based on an investor's total portfolio. There is risk, there is absolute yield, and some of our investors are really, really sophisticated commercial real estate people. So they can look at these joint venture equity agreements and they get upset that a certain clause isn't in there, or it's a clause from 2014 when we should have used the most recent. So some of the negotiations and some of the questions get really, really sophisticated. Some of the investors are doctors, and they don't understand some of the nuances of whether a second deed in the state of Arizona is equivalent to a mortgage in the state of New Jersey and the difference. So there's a layer of complexity that typically investors are very much up to speed. And I think I got a little bit off track, but I forget the original question.
But it gives you a scope of the investors. I said, do you have any other tips on how to vet
how do investors approach? You know, one of the things that's interesting about right now, I think, for investors in general, is that there are a lot of platforms that are very focused on a lot of different things. There's expertise throughout teams. But now is a great time for investors to reach out to platforms because everybody wants to help. And I feel like sometimes, certainly at different points in my career, I've been more willing and less willing to ask the dumb question. Right now is the time to ask the dumb question because he's got a whole team, I've got a whole team. Everybody in the industry is willing to provide answers on how this works. How are you vetting deals? What's the process? Where does the money go? What does the document look like that actually signs? So I want to encourage investors. The smart thing to do is ask questions.
I'll just add on to that. It was a great point. Is now that we've been at this for a few years, you should be looking at these platforms. Besides, obviously, the team that's been formed. What's the performance of that marketplace, right? And if the platform is not clearly showing you their performance, right, and the data, that's not very transparent, right? And I think that's something at CrowdStreet we've prided ourselves in. As we brought sponsors onto our marketplace, they had to be transparent about everything about their deal. We also have to be transparent about how are those deals performing on the marketplace. And then I'd say as an investor, it's also important to look and say, what is the vetting process that sponsors have to go through before they make it on the marketplace? We only accept from the top of the funnel in terms of sponsors and leads that come to us to the bottom in terms of who makes it on. It's about a 5% rate that actually makes it onto the marketplace. So 95% that start never make it to the marketplace. I think that's really important from an investor perspective to kind of know, this is not Craigslist, right? It's not just anything gets thrown up there. This is serious business. It's commercial real estate investing. And I think, having all those aspects is really important for investors.
And since you mentioned sponsors, from their perspective, what's in it for them to take an investment from you? There's, all these traditional sources of capital. Why would they want to work with you?
Yeah, I think that's a great question. And primarily the sponsors that we work with are called mid-market sponsors. Their projects are in that 10 to 50 million range. The equity portion is usually anywhere from $3 to $8 to $10 million. So they've traditionally raised capital from high net worth investors. 98% of the sponsors that have been on our marketplace have between 50 and 500 high net worth investors in their local market. I call it their private network, right? Friends, family, country club money, if you will. And so really for them, they look at this and say, wow, I'm now able to advertise, because under Reg D 506C, they can generally advertise to accredited investors. I can now advertise that I have an offering, and I might be based in New York City. I might have a project in New York, but I'm now able to get investors from San Francisco, Seattle, Chicago, all over the country. They're the same type of investors that I had in my local region, and I can do it a lot more efficiently. So they can raise capital, they can do it more efficiently, and again, then they can get back to doing what they do best, which is the real estate, and not actually managing investors. So they love the fact that we're also bringing in a technology solution to enable them to manage the investors post-fundraising.
Do they have a lower cost of capital by going with you?
They do. I mean, traditionally, they're like, they might have gone through brokers, they might have gone through placement agents in the offline world, and so they've been paying high commissions. And at the end of the day, those fees a lot of times get passed on to investors. So I think the investors actually win in the end because they're using platforms with a lower cost of capital for them.
I want to mirror those observations. A lot of the sponsors that we interact with are coming out of the friends and family universe, and they're generally have demonstrated some expertise and they really need to grow. They can't yet approach a private equity fund that really has a minimum investment of $100 million. It's just not interesting for them. couple $1 million from a crowdfunding platform is really great. And one of the key things that we can do is we can create the structure essentially however we best see fit. The friends and family are used to the structure they've gotten for the last 10 years and they want the same thing. So we can put together something that maybe has a little bit less yield, a little bit less cost to the sponsor, and maybe even structure it so that investors are a little bit more interested. And one of the key things that we like to do is go a little bit lower in the capital stack, maybe cap the yield for our investors, and that way, given a stress test, our investors are protected, not only their principal, but also their projected interest.
Thank you. So we're talking about accredited, non-accredited investors. Let me ask you a question, Jamie, about the different regulations which different platforms could possibly use to raise funds. Do some allow for accredited investors, some allow for non-accredited? Can you distinguish between them and what's allowed, what's not allowed under different rules?
Sure, and I will, so both of their platforms use Regulation D, which is 506C, which under the Jobs Act was made looser as far as like general solicitation. And Reg D, you basically can raise unlimited amount of funds, but it's only to accredited investors. And then there's two other exemptions that we see that a lot of companies are using. Regulation CF, which is up to $1 million, which in the real estate space, you know, is probably limited in functionality.
That's the max you can raise under that?
You can raise $1 million, $1,070,000 a year.
Okay.
Which for, you know, small companies is a great, it's a great, what's it called? It's a great choice for real estate investors. You know, a lot of these projects are going to need much more capital than that. The other one that we're seeing a lot of companies using for real estate is actually Regulation A, which goes through, it's like a mini IPO process. So you go a little bit back and forth with the SEC, you get qualified, and you can raise up to $50 million in any given year. And you talk about, and with Reg A, because you're going through the SEC, like, you know, you're going to have very required and prescriptive disclosure. So you're going to have a lot more information. You might even, depending on who's working with you, you might even have, you know, similar to an S11 if anyone's ever seen like a registered deal in the real estate space. And you're also going to have, you know, information on the sponsor that's going to be very specific that, like, you know, people can look at, and they can look at two different deals and see, like, you know, whether they're registered or Reg A, like, you know, apples to apples, and, like, you know, what they're getting as far as disclosure. And for Reg A, you can actually sell to non-accredited and accredited investors. And the difference is, you know, non-accredited investors are just going to have an annual limit on how much they can invest based on, you know, a combination of their income and their assets.
Can you, or Tor or Jamie, can you define what's an accredited investor, what's a non-accredited investor? How do you get accredited?
Sure, it's just going to be how much you make and your assets. So if you have, you know, spouse or a single person, make $200,000 for an individual, $300,000 for a couple over like a couple years, or you have assets not including your home about $1 million. Is accredited. So it's nothing more than that. You're just gonna have. That's who you like. You know what you can bring to the table.
So does CrowdStreet?
Yeah, and there's about 12. I don't know any estimate. 12 to 14 million, you know, accredited households in the U.S. And I think, you know, there has been discussion amongst administration and Congress of actually changing the limits a little bit. So you might actually see more people that could qualify as accredited. Although a few years ago they were talking about tightening it. So who knows which way they'll go? But I think they're talking about, hey, you know, it is kind of an artificial test that's been put in place, but it's an SEC guideline in terms of what a standard accredited investor is.
You know, we're here, the title of the conference is The Future of Crowdfunding, and I think that there's no doubt that people are interested in allowing access to these investment opportunities to as many people as possible. Where we are today and where we are in the future is going to be different, but there's no question that this accredited investor definition right now has an impact on where we are today. And in the world of commercial real estate, in order for this to be really scalable, and when we have an average investment size north of $25,000, accredited investors are really the name of the game for us right now. There are platforms, and I'm sure that both of our platforms are interested in figuring out how we can access the non-accredited universe in a meaningful way. And it hasn't been figured out yet, but in the future, it will be figured out.
Did you mention, I think we were talking that you might have had a way to address some of the accredited investor, non-accredited investors?
Yeah, we tried a couple of the Reg A offerings, and I think it really has to be, again, having seen this play out the last few years, it was the supply side, the sponsors, the developers and operators, right? They're the ones bringing the project. So in a way, they have to, in their mind, want to do this, right? And I think a few years ago to get them to convert to a Reg D 506C, a general advertising, and go online. That was a big deal for them. To lower their minimum from $250,000 to $25,000 and say you're going to go online and now you're going to meet investors across the U.S. that you're only going to know in an online way as opposed to, they're in your local region. That was a big paradigm shift. To get them to go and say take non-accredited investor at $1,000 or $5,000 investment, that's a big shift. Yeah. But we have seen some of them that have adopted a Reg A filing that's traditionally been for a large fund, right? $30, $40 million, $50 million real estate fund, because it does cost them legal, tax, SEC process to do that. So for a single asset deal, it's kind of prohibitive. I think over time, as maybe the Reg CF limit, if it goes from $1 million up to $25 million, that's an easier process for somebody raising capital for a $30 million project to be able to say, maybe I could let non-accredited investors in.
So we're on the way, but we're not
on the way.
Quite.
I think we're definitely not there yet.
Not there.
Yeah.
Well, I guess the one question that I think a lot of people have is returns. I mean, we open up. What kind of returns can people expect? You're considering this against other investments. You want to open it up?
Sure. The general minimum that we target for returns is 12%. On average, I think our returns cap out in the high teens. I would say probably 18%, but there's no question that certain offerings are going to be north of 20% IRR. Now, when you're looking at a 5-year forecast, some of the assumptions get very gray and get very fuzzy. We do like to have shorter-term deals so that we can use underwriting assumptions that don't rely on a 5-year forecast, and in fact, they're generally going to assume market pricing as of today. One observation I'll make is I just noticed the time, we're also running a little bit short. The Wall Street Journal, which isn't a bad publication, it's no Bloomberg for sure. But I think that the GDP reported growth was 3.5% for this most recent quarter. It was 4.2%, and the head title was it's all downhill from here. So I think that there's a sentiment out there that's appropriate, and it's certainly any investor, and we certainly take into consideration how long this cycle has gone on, but there is still positive GDP growth. So the yields might compress a little bit, and interest rates are going to have an impact on where we see exits. When you're making a 5-year forecast, where interest rates are going to be in 5 years is something that's really difficult. So we like short-term deals. We like a low of 12. We're generally targeting a high of 18, and we try to get that accomplished in 2 years with value-add deals.
I think, as investors look at that kind of return profile, they need to consider risk and reward, right? And I think one of the things, as we talked about diversity, another thing about diversity is to look for deals with different, what I'd call investment profiles. Everything from a core plus or core type of deal, which would be a trophy office building, Class A space, that might have a 12% IRR. It might have a current cash of like a 6%. Not exactly knock it out of the parks, but a lower risk, right? And then on the other side of the spectrum, you'd have an opportunistic deal that could be a redevelopment of a industrial or storage or senior housing, needs a lot of TLC, right? And the investment thesis is that the sponsor is going to turn that asset around. That might have a 30% IRR, but it's a higher risk, right? And I like to kind of, when I talk to investors, say, it's kind of like stocks, right? You don't buy all small cap growth. You usually buy some large cap value. And there's a risk kind of coefficient here that people need to take advantage of and look at and say, how do I want to build my portfolio? And what is outside of real estate? Am I super aggressive there? And when you look at marketplaces, on our marketplace, we've had 10 round trips, fully realized deals on the marketplace. The average XIRR in those has been 32%. And I always caution and say, hey, this is early, because those were ground-up developments, right, that already had a high kind of IRR basis. There were also deals where the sponsor got made an offer that he or she couldn't refuse, right? They might have had a 5-year investment horizon, but they got offered an unbelievable deal to take that out early. So we'll see that smooth over time. We also track the performance of all the existing investments that have an average 5 to 7 year life. And we look at what is their current cash that they're producing, and on average it's about 8.5%.
And do you want to talk about fee structures? What kind of fees are investors potentially looking at?
I'll let, you mean from like Reg A space?
Just from the actual funds. Okay. I'm going to ask you, sorry, apology. But you can feel free to contribute as well.
So I'll maybe, do you want to talk about any fees that you're seing from a Reg A perspective? They're just getting passed on to the investors?
A lot of them are just getting passed on to the investors as far as the fees are concerned. I mean, which fees are you talking about?
Fees to investors or the sponsor fees?
It depends what we're seeing. Like, you know, the broker-dealer fees, a lot of them are not necessarily getting passed on to the investors, but or not going to get reflected in the hurdle rates and other things. But some of the other fees are getting directly passed on to the investors.
So the way CrowdStreet looked at fees from day one was we said it's not right to charge investors a fee just to register on CrowdStreet and to participate, right? So today, the investors, they're investing directly into that sponsor's deal. We're providing content, we're providing access, transparency, our vetting process, so we don't charge investors a fee to kind of do it themselves, the do-it-yourself investor. However, we did hear from many investors the last couple of years who said, CrowdStreet, you know, you've got 30 to 35 offerings at any given time, cross-geo, cross-asset type. Can you make it easier for me? Could you like bundle up these offerings into a kind of fund or a portfolio? So we just launched 2 weeks ago the CrowdStreet Blended Portfolio, and now we will be charging investors a fee to participate, and it's a 1% asset management fee, a pretty standard fee. But as we raise capital for that blended portfolio, it will start deploying the capital into between 30 and 50 of the offerings next year. So it'll give investors an automatic diversification for a low minimum amount.
Crowdfunding in general remains a nascent industry. Commercial real estate crowdfunding continues to evolve. So one of the questions about valuing these companies and how do we create companies that are profitable is what's the appropriate fee level. And so sponsors that would hire a broker to go out and raise joint venture equity capital could charge a fee as high as 3%. In certain instances, if we're really high in the capital stack and it's a relatively difficult raise, and by difficult, I simply mean a challenging story that has complexity that maybe is a little bit more sophisticated, 3% might be right. It could just be 2% up front, and it could even be, if it's a senior debt deal, as low as a point. And that we charge to the sponsor. And so that allows us to create an offering. And we're a little bit different than CrowdStreet in that we collect capital directly from investors, and then we aggregate that capital and make a single investment via an SPV. And then as we make distributions, we typically charge an asset management or servicing fee. And that's traditionally consistent with what any bank or any servicing provider would do in order to make distributions. It could be as low as 25 basis points. It could be as high as a point, depending on complexity of the transaction. If it's an aggressive value add or opportunistic deal, then there's a lot more hand-holding that goes on, asset management fee goes up. We also like to structure in exit fees, and so those exit fees are generally contingent on a successful exit, and it is consistent with our co-investment philosophy. Investors get all their money back, the story went as we forecast, we're going to take a little fee at the end as well. So that's a philosophy that we think is fair. It's a philosophy that we think allows crowdfunding to be sustainable and ultimately profitable, not only today, but well into the future.
We have about a minute and a half left, but I want to open it up to what does this space look like in 5 years or in 10 years? What's the future of real estate crowdfunding?
So I might not be bullish on the Reg CF limit getting raised, but I can see a lot more not only the Reg D spaces opening up, because I think it's been quite successful, but I think Reg A, I think there's going to be a lot of companies using Reg A also to access capital.
I think one of the things you're going to see, and again, we're in the, hate to use the baseball analogy, still the first inning, right? We're scratching the surface. There's close to $300 billion of equity that flows through commercial real estate every year, right? CrowdStreet's proud that we've done $400 million of equity. That's a fraction. So we're opening access to and transparency to invest in commercial real estate. I think the next kind of major thing is you're going to see opportunities to create commercial real estate from being an illiquid investment into a more liquid investment. And what I mean by that is potential secondary market opportunities, right? Today, when you invest in that LLC as an LP, you're in that deal for the most part, right? We're going to see exchanges pop up. We're going to see leveraging technologies like blockchain to enable that. And so I think that is kind of the next horizon, as now investors have ability to invest, is the ability then to make secondary markets out of that.
Daniel?
I agree we're in the first inning. I did an analysis on this and attempted to come to a conclusion. And there's one way to do it, and that is define the scope of the commercial real estate market in the United States. Assume roughly 10% of that turns every year. which would be an average of 10-year hold, how much of that market can crowdfunding touch? And we haven't really made a mark. Once we do make a mark, and there's private equity funds out there, and there's a lot of major owners, the conversation is going to become more different, will become different. And over 5 years, there's going to be more competition. I think that we're going to be a lot more efficient about how we get this done. And I think investors are going to ultimately be much more comfortable with the process and realize that the access to this risk and this yield is really unique and is really kind of a special thing versus other avenues.